Welcome to another episode of Wealth Uncensored. I'm sitting here today with my longtime friend and colleague, Toby Mathis, a lawyer, tax expert, and a founding partner of Anderson Advisors in Las Vegas. But I think you guys have more offices than just Las Vegas. Maybe you could tell us a little bit about what exactly you guys do and where you have offices and the types of clients you service.
First off, thanks, Jimmy. We've known each other for a long time. The main office is for Anderson. We have Anderson Global, which is our holding entities are in the Caymans. We have about 5 companies there. Dubai, France, Italy, Switzerland, a few others. And then domestically, which is where I spend all my time in the United States, our main offices are in Las Vegas, Cheyenne, Wyoming, Draper, Utah, and Tacoma, Washington. But we have a presence in all 50 states as a registered agent for companies.
And what's your primary business service that you offer?
Our focus is on a trilogy, which is asset protection, tax planning, and estate planning for investors. Really specifically, we're looking at mom and pop businesses where it's just trying to get into some of the bigger firms. It's just a nightmare and it's not going to be cost effective for them. So we try to give them solutions that they can implement. We're big educators. So I would say our primary function is to teach people what their options are. We have a heavy presence in social media and other things where we're just giving away information so people can make wise decisions.
One of the questions that I get all the time from American taxpayers is, how do I save taxes by going offshore? You even sent me a few clients had the same question. And the short answer is, welcome to the Wealth Uncensored podcast, straight talk about everything that impacts your wealth. In each episode, I share what I've learned through my own experience and 2 decades of helping high net worth clients structure their affairs to minimize taxes and protect their assets for the next generation. I'll also feature special guests who are experts in their own field, sharing their knowledge and experience to help you protect what's yours. I'm your host, Jimmy Sexton. Let's dive into today's show. Oh, you don't. If anything, you're going to pay more taxes, most likely, and have a higher risk of audit, potential penalties, and stuff like that. And so then their next question is, how do I save taxes domestically? What can I do to reduce my taxes at a purely domestic level? And that's a little bit beyond my knowledge base, but I know that this is your expertise. We've worked on a few clients like that. I wanted to get your insights on what sort of strategies people can use purely domestically to reduce their taxes in the U.S.
Yeah, it's always the question you get is people feel a lot of pain as they get into the upper levels of the income tax brackets. The highest in federal right now is 37%, could go back to 39.6, and that's just the federal, plus you got the state, plus you got Social Security taxes and Medicare. So when you add everything up together, you could be looking at a 50% tax burden, which would cause anybody to say, how do I make this pain stop? So they look offshore, like you said, unless they have a real reason to go offshore with a business presence and activities outside the United States. It's usually a recipe for disaster. So that leaves us looking domestically. And realistically, I think it comes down to establishing a family office for most people. And when I say a family office, a management entity, that's ultimately going to be the tool that we use to generate typical business deductions that businesses are entitled to, but that individual investors are not. And you have 2 flavors, really. You could go profit or nonprofit. We just saw Warren Buffett writing a letter to his shareholders where he was dumping in, $1.2 billion into 4 family foundations. And he says, I'm not worried about my legacy of my family. Okay, you just created billions of dollars in these foundations that your family's going to shepherd now for an eternity, because that's a huge amount of money. And these are tax exempt entities that will never pay tax. And these folks can draw a salary out of there pretty much infinitely. So how do you say you're creating a family legacy without saying you're creating a family legacy? Is you create a foundation. There's nonprofits. There can be nonprofits that actually do something, that maybe educate or provide housing, transitional housing, residential assisted living, Section 8 housing. All those things qualify as nonprofit activity, and you can create an entity that not only doesn't pay tax, but that you can get a tax deduction for just putting money or assets into it. You can literally transfer a house I've held for the last 10 years that's doubled in value, and if I want to write that whole house off, I could donate it to my own charity. So there's always an opportunity there for anybody who understands how the tax code works to minimize their taxes and to create a scenario where they can actually create something that's going to last long term. So it really comes down to first decision. Is it just tax relief where I'm just trying to get what I should be entitled to? but I'm not because I don't have the right advisor. I'm not taking advantage of the right laws. I haven't established the right structure. Or is it something where you're saying, hey, I'm established and I have a substantial net worth that I want to transition and create a legacy for my family? And you don't have to say either or. You could do both. But that's usually where you start. You're saying, hey, this could be somebody who's $100,000 a year who says, I'm not getting to write off things like my cell phone or my computers or my equipment or my travel. Or, hey, I really like to continue down the journey of learning investments. And I know that there's a tuition cost for it and things like that I don't get to write off individually. And they establish a family office so that they can actually deduct those things plus things like administrative office for the home, 280A, the Augusta rule. There's all sorts of little nuggets in there that they can take advantage of. And it's usually worthwhile, even if you're in the $100,000 range. And then there's people that are bigger. And as the appetite increases, you start looking at other things.
So just so I understand it correctly, so on the family office level, we're looking at the tax-exempt foundation or sort of a management entity. And on the tax-exempt foundation side, essentially, a person's putting money into it, getting a tax deduction for doing that, then probably putting the family members on the board. The money that's in the foundation can be invested, can grow tax-free. Obviously it needs to do some good and provide some benefit, whether that be to other charities or the general public. But the advantage is you have this amount of money that you've got a tax deduction for putting in. It's growing tax-free and your family can be on the board. Like you said, they can draw salaries, certain business expenses can be paid out of that. And essentially, it can be a way to grow wealth exponentially and support the family in the longer term.
Yeah, let me give you a good example. One of our clients is second generation of having a family foundation. So they served on the board when they were kids, and now it's their turn. Their kids are going to serve on the board. They've been drawing a salary out there the entire time, I think $60,000, $70,000 a year in their case. And all they're doing is shepherding money where they give away 5% a year to qualified charities. That's their situation. And they're growing substantially faster than that 5%. And it's able to sustain itself. So they're actually continuing to grow the asset base, even though they're taking money out and it's covering expenses and it's covering business expenses and things like that. And it's not subject to estate tax. It's exempt, so it's not subject to any taxes. The only thing you have to do is give 5% away, and that trips people up sometimes. It's, oh, but I don't want to give away. Okay, then do something. You create a public charity, which people, again, misunderstand. You could do that individually, or a private operating foundation like Bill and Melinda Gates did. You could create these things where they're not required to give away money too. The whole idea, though, is to create a structure that doesn't die, that doesn't have to go through probate every time a generation passes, and gives you the tax benefits that you should be entitled to for operating a business. And the nonprofit realm, my gosh, I can get a tax deduction just end of the year. Like here we are sitting towards the end of the year. I need a deduction, write a check. I need a deduction, transfer some stock. You get fair market value deduction. I got Bitcoin. Yep, get it valued, transfer that. You get to write off every nickel that you put in. There's some limitations as far as adjusted gross income. But for the most part, for average people, yeah, you get to write off every dollar that you're putting into it. Plus, it's now tax exempt. Plus, you can now train your family to actually operate your investments correctly. You don't have to worry about family members getting into bad divorces or getting lawsuits or wasting away the money because they decided they really wanted a Ferrari and a really expensive house. All that stuff goes to the wayside when you start operating within that parameter. You could ignore that and you could go straight to the for-profit where you say, yeah, I want all the glitz and all the benefits. Again, you could do both of them, but you want to have a structure where you're saying, hey, we're going to operate in a business-like manner with a board where I can train my family members to actually operate these things. Because statistically, you're toast if you don't.
One of the things that I found really interesting, especially with the private foundations, you were saying you have to give away 5% of the asset value a year. The trick is obviously your growth has to exceed that 5% and your expenses, which shouldn't be too difficult to do. But what I always thought was really interesting is that included in that 5% you need to give away is actually evaluating what you're going to give it away to. So if you need to go to a gala dinner or something like that to see what the pitch is, theoretically that could be included in that 5%, including all the travel and all the stuff needed to go there. So it is actually a quite flexible structure.
I can tell you this, we have very few private foundations. Most people say, oh, you mean if I do housing that's moderate to low income and there's a safe harbor as long as 70% is that type of housing, I am exempt and I don't have to give anything away? Sign me up for that. Or they'll actually operate traditional charity or church or something else or support organization. We have a ton of them. We've literally done thousands of these.
Wow.
And what I've seen, and I know this isn't quite on topic for what you wanted to go over today, but what I've seen is the money goes in and rarely are they taking out salaries, other forms of compensation. Usually it's a tax relief vehicle. It's an exempt vehicle that people get behind, the family gets behind, and rarely they can take a salary, but rarely do they take a salary. Because why would I take a salary and have to pay tax when I could just leave it in there and not? And 90% of the time that people are like, yep, I'm good out here. I'm doing well in the for-profit realm. I don't need that extra money in my personal realm. I don't need to pay tax on it. I'm going to leave it there. And then on the for-profit side, a lot of the benefits are tax-free. They're non-reportable. So, at the end of the day, you can get to that place where you're getting the tax relief just by doing things intelligently by operating a business. Maybe it's reimbursing you, like I always say, like cell phones and things like that. You don't get to just write those off as an individual. But even if you were a sole proprietor or running a real estate business, you'd have to say, here's the business use, here's the personal use. When you have a family office, it can reimburse 100%. Just boom, done. Administrative office in your home. Here, let's pay off 15-20% of the expense of your home. Boom, done. Tax-free, not reported, easy, simple, operate business-like manner, really works effectively for most people.
When we talk about the management company structure for a family office, so essentially what you're doing is setting up a business to manage your investments, right? You would receive some sort of a management fee for managing the investments, and then it would be able to write off the various business expenses that otherwise wouldn't be deductible as long as they're in connection with managing the investments.
Yeah. Let me give you a really good example. So in the United States, if you are a stock trader, you get investment expense, section 212, I believe is the code. And you don't get your regular, ordinary, necessary business expenses like the guy down the street who opens up a pizza shop. You don't get those expenses. You don't get to write off going to conferences. You don't get to write off just about anything. You don't get to write off your expenses. Maybe the interest, the margin interest you pay on an account, you write that off. Congratulations. But you don't get to write off all the other things unless you rise to the level of a trader. And they have this thing called trader status, which means you're trading 70% of the days the market's open, more than 750 trades a year. It has to be your primary source of income. Can't take long vacations, things like that. But they'll say, okay, you can write off the expenses. That's great. And then they audit the hell out of all. So the workaround is simply to have an LLC or a limited partnership, either one works, that holds your stock in your liquid investments. So if you're doing anything that's dividend producing, interest producing, capital gain producing, get it in an entity and then partner with your family office. So the family office might own 20%. Now, what automatically happens is that family office is now being funded with 20% of the profit. It doesn't flow onto your return anymore. It goes to the family office, which then expenses it. And the family office gets to write off ordinary necessary business expenses under Section 162. It's just a basic way of structuring it. And you could do that with real estate too. You could have it maybe not with the ownership. I don't want to have ownership in a family office or ownership of real estate inside of a corporate entity, but it could still be paid that management fee. We have to do it this way in stock trading because the Tax Cut and Jobs Act got rid of miscellaneous itemized deductions. So we can't just write off what you pay to your company. So it has to be a partner, has to be a guaranteed payment to partner, has to flow to that entity as either an interest in the profit or as a guaranteed payment to partner. But you get to write those off if you structure it correctly. So the end point here is you could have two taxpayers. You and I are both doing the same thing. You don't get to write anything off. You get no benefits. It's all in your name. You're getting hammered from a tax standpoint. And then me, I structure it differently. And I literally could be tax exempt or I could just be getting lots of tax benefits. But there's one thing I'm not, and that's getting beat up on my taxes. And now I have an effective vehicle also for estate planning, tax planning, and I don't want to minimize this, asset protection. You can create a structure where nobody can even see what you have. Even if they could, even if they sued the lights out of you, they couldn't take it. So all those three things are really important for a lot of folks. It's okay, I want to make sure nobody can take it from me. I want to make sure I'm getting tax relief, and I want to make sure that my family can continue what I create into the future.
Yeah, I think that's all great advice. So are there any other sort of strategies that are out there for people that are investing in real estate, for example, or anything like that where they can save some money on their taxes?
Huge. Yeah. Whatever you're dealing with real estate, it's a passive activity for the most part. There are three ways that a typical person, you and me, could actually take a large deduction and offset, let's say, our W-2 wages by using real estate activities. Traditionally, you have what's called passive activity loss rules, and your accountant's going to say, hey, if we create loss in real estate, and if you've ever paid attention to the news, you know that President Trump had that $90 million of tax savings he did something called a cost segregation and carryback of accelerated depreciation. He had bonus depreciation. Those things are out there for us. So we can create paper losses, but you can't offset your active income, your wages, for example, with those passive losses unless you fall into one of these three categories. Category one is I'm an active participant, I manage the manager, and I'm below $150,000 of modified adjusted gross income. If I'm in there, I could write off up to $25,000 a year of those losses. Second, option two, real estate professional. This is one spouse spends more than 750 hours in real estate trader activities. It could be construction, it could be an agent, there's a whole list of about 11 different activities. And you materially participate in your rental properties. So you're spending at least, let's just say, 100 hours a year on your rental activities, and you aggregate them as one activity. There's some tax nuances, but you end up then releasing those. There are some total limitations on net operating losses. I think it's almost $700,000 this year. There's some limitations, but for most people, you never have to worry about that. You're just getting big losses that's offsetting your income. And then the third way is doing Airbnbs or VRBOs, something called short-term rentals. And when you do, that's not even rental activity, and it could be non-passive just because it's 7 days or less activity. You're basically a hotel, and the IRS treats it differently. They treat it as regular trader business income. So yes, if you're in real estate, sometimes it's making sure that you're treating your real estate appropriately and you're aware just how close you are to some significant tax relief. And you're in the tax world with me. We always say in real estate, if you're paying taxes, it's because you don't own enough real estate. All you have to do, generally speaking, in real estate is, hey, I want to do more of it. Great. Here's all these tax benefits. Yep. And again, we have a president that happens to be an expert at doing that. Plus, he did the charitable stuff with the conservation easements on Mar-a-Lago and all his golf courses. He understands the tax code, so he doesn't pay taxes. And that could be anybody, as far as I'm concerned.
Okay. So if you're not in real estate and you're not at the level where setting up a family office makes sense, is there anything else out there that might be interesting to people where they could potentially save some taxes?
Yeah, absolutely. Even if you don't do the family office, as long as you start a business. If I started a business this year, let's say I was going to buy a Turo, I was going to do some cars, and end of the year, I buy a car, put it into service. I'm still going to get a massive tax deduction this year for doing that. Or if I say I'm going to do a pizza shop and I buy the pizza oven before the end of the year, put it in service, boom, I could have a massive tax deduction just like that, depending on how I structure that business. Yes, there are plenty of ways. You could do oil and gas. Hey, if you're not aware of how oil and gas works, there's something called intangible drilling costs, which are treated as non-passive ordinary loss. So I could invest in, let's say, put a $50,000 into some oil and gas investments. I'm going to get my money back over the next 10, 15 years, but that $50,000, more than likely about 80% of it will be a tax deduction this year. People don't understand that even exists. So there are different types of investments. And then, of course, if you do go the route and say, hey, you know what, I do the charitable thing, I do want to create a family legacy, you could do a donor advised fund. You could transfer money into it. Boom, take that deduction this year, invest that money. There's no time. So I could just, for the next 10 years, just trade that account in a tax exempt vehicle, create my charity 10 years from now, dump the money into it, and I'm good to go. Yeah. So there's plenty of opportunities. It's just talking to somebody that actually knows what they're doing. That's the hard part.
That's what I was going to say. Like you were saying, a lot of what you guys do is education. It's you got to find somebody that, one, is willing to really dive into your situation and see what you have and where you're at, and then is willing to take the time to talk to you to see what types of things you're open to, what types of things might interest you in order to create a plan to save. Because there is a lot of opportunities out there, but unfortunately, most people spend not very much time with a tax advisor. They just go to their tax preparer once a year. This, here's my shoebox of stuff, prepare my return. But like with anything, you get out of what you put into it.
Yep. And I personally believe that tax planning is $1,000 an hour activity. That if you put time into tax planning, you're going to put a lot of money back in your pocket. And when I say $1,000 an hour per year, per infinity. So if you put a few hours in place now and it saves you $3 or $4 grand this year, it's going to save you $3 or $4 grand next year, the year after. It's an exponential activity. People that don't do tax planning, I always shake my head and go, you're going to really regret it 10 years from now when you look at it and you say, I could have done this. You overpaid your taxes by $10,000 a year because of the way you made a tax election on an entity. Really? Yeah. Wouldn't you love to have that $10,000 a year back in your pocket? I'm sure most people would usually start to lose their mind at that point. And especially when it's a larger amount, 40, 50 grand a year, people start to get that eye twitch and they get a little angry. But you're saying, let's do it ahead of time. Let's get that planning. Proactively make sure that you're not in that scenario where you're overpaying when you could have chosen to underpay instead.
Yeah, for sure. Well, Toby, thank you so much for your time. It's always a pleasure talking tax with you. And listen, I'm sure we'll be talking and hope to have you on a future podcast.
Absolutely.
Thank you for joining me on Wealth Uncensored, where we help you minimize taxes and protect your wealth for the next generation. If you like our show, be sure to subscribe and leave a review. And if you have any questions or suggestions for future episodes, we'd love to hear from you. You can email us at info@esquiregroup.com. And don't forget to visit Esquire Group's website for more information on how we can help you secure your wealth. I'll be dropping knowledge again next week. Don't forget to join us.